Okay, so we can start and we analyze the so-called peaks. So Portugal, Ireland, Italy, Greece, and Spain. All variables are compared respect to the benchmark country, Germany. Okay, this picture, figure 4.1, shows the difference between the 10 years bond of the so-called PIGS, so Greece, Portugal, Ireland, Italy, and Spain, respect to Germany, in the period 2000-2012. We can distinguish two phases between 2000 and 2008. Spreads are very close to zero between interest rates in PIGS countries and Germany. After 2008, we can see the increasing in spreads, in particular for Greece, Portugal, and Ireland. Okay, we can start with the main events. In 2008, we can see the starting point with the first increase in spreads after the Lehman Brothers collapse and the Irish banking crisis. Spreads started to decrease in February 2009 when Irish government um, announced austerity measure to decrease the budget deficits. And again, the spreads started to rise in November 2009 when the new Greek government announced that the budget deficits was twice the expected budget deficits previously estimated. Looking at table 2, table 4, we can see after the global financial crisis of 2008, in table 2, the negative growth rate of GDP. So for Greece, we can see 1, 2, 3, 4, 5 years of negative growth of GDP, which means high level of unemployment. In table 3, we can see after the global financial crisis the increase in the deficit GDP ratio in Ireland, for instance, and the increase in debt GDP ratio in table 4 until today. And this increase has been observed even if governments in the Eurozone have adopted strong austerity measures. Existing studies have identified the main explanatory factors of the current increase or the increasing in the spreads in the euro area. The first factor existing literature identifies the global common risk aversion using, for instance, the Chicago VIX X index, which means the volatility index in the US stock market, or for instance using the difference, the spread between the triple A ranked US corporate bond and the corresponding treasury bond of US government. When we observe an increase in the global risk aversion coefficients of VIX index or the spreads of AAA corporate bond in US, we have an increase in the perceived risk aversion, and this can explain the current the increase in spreads in the euro area. Other studies pointed out the role of the default risk using GDP deficit or public government debt GDP ratio using indicators such as fiscal space or the current account deficit or indicators on the financial fragility of the system. But these indicators was found to be prominent after the reluctance showed by Germany in the bailout of Greece. After this reluctance by the German government, markets started to price risk on government bond in the Eurozone on a country-by-country perspective, as we can see in the picture. Before 2008, we have this the spreads close to zero. After 2009, this widening in spreads, which means that market is considering risk on a country level and not at euro area level. Several papers identify also as important explanatory factor the liquidity risk premium, measured by the ratio between the government debt of a specific country respect to the total government debt in the euro area. This is a proxy of liquidity, and this indicator was found prominent after the introduction of the euro and during the financial turbulence after 2008. There are also studies trying to explain spreads movement using high frequency data, using news about, for instance, rating on government bond, government debt. But there are the main conclusions are that at least that using low frequency data, using these studies, the main factors explaining spreads are global risk aversion, default risk, and liquidity risk premium. After 2010, many studies shows that variables used in the previous studies, so global common risk aversion, default risk, or liquidity risk premium, did not explain a significant portion of sovereign spreads, so after the 2010. So there are studies trying to explain these spreads using financial contagion from Greece to other no-core countries. Or some other authors have introduced the risk of a euro breakup as a new component of systemic risk to explain the widening in spreads after 2010. Our approach is to use our indicator of euro sustainability, which we say again is country-based indicator.